Hi, and welcome back to Stop Being Sold. My name is Michelle, and I'm here with Brian. And in today's video, we're doing a deep dive into fixed annuities. Now, might not sound like the sexiest topic in the world or the most fun, right? But it's really important, with so many different types of annuities out there, and they're complex. It's important to understand what you are going to buy or what you own. So this video on fixed annuities, we're going to also explain to you what you need to know so that you don't get locked into a contract that's going to cost you way more than you bargained for. And this is a video that's part of our larger series called Annuities Exposed. We cover SPIAs, we cover variables, you name it. Those links are in the description below, so make sure to check those out.
Yeah, Michelle, this is so important that you understand what you're buying, especially with annuities today. So too many people are sold annuities. Okay. In fact, $254.8 billion in annuities were sold in 2021, according to the Life Insurance Marketing and Research Association, LIMRA. And annuities are a big business. And they can be a great product for the right person, especially, Michelle, when they're customized to your specific needs.
Right.
So that's why we're running this series on Annuities Exposed. But for today, we're going to focus on fixed annuities. So,
all right. So before we dive into this content, if you enjoyed the video, hit that like button, make sure you subscribe to the channel and hit that notification bell so you never miss another video from us on how to stop being a transaction or how to stop being sold annuities and become an informed consumer with a solid financial future. All right, Brian, let's hit it. Define fixed annuities for us, please.
Yeah, fixed annuities, Michelle, like other annuities, are a contract between you and an insurance company. They pay a fixed rate of return based on the contract terms and may also provide an income in retirement for you. You usually see fixed annuities have a range of anywhere from 1 to 10 years, Michelle.
All right. So how do they work?
In simplest terms, you usually pay a lump sum of money to an insurance company.
Okay.
And they give you a specified amount of interest for a certain number of years that can be turned into an income later in retirement. For example, let's say you deposit $10,000 to ABC Insurance Company for the next 5 years. Then they guarantee you a fixed rate of 3%. At the end of the 5-year period, you can take your money and run, renew it again at the new interest rate that they offer, or turn it into an income stream. Depends on your specific contract, though.
So, yeah, that's a big thing. If you've been on this channel, if you've seen any of our annuity videos, you know the devil's in the details.
Yes,
and it's all about the contract. Make sure you read the fine print and not just read it, but understand it. All right.
Definitely.
So, okay. So you talked a little bit about how they're used. They can be, you put the money in, you can get an income stream later on. You get a fixed return rate. So I'm assuming that that fixed annuities are more used for accumulating and are safer than chasing stock market returns.
Oh yeah.
Correct?
Definitely. Yes,
yeah.
Definitely.
And they're also so they're kind of like CDs.
Kind of.
But not really, right?
No,
I mean, it's you save and accumulate, but you can compare them. All right. So let's talk about the pros and the pros. We'll start with the pros and then we'll go to the cons. So the advantages of fixed annuities.
Yeah, it's pretty simple. We've talked about this many times. Tax deferred accumulation of your savings.
Okay.
Typically higher interest rates than most CDs that are being offered out there today.
Mm-hmm.
They give you a guaranteed interest rate for, a specific amount of time.
Mm-hmm.
And you mentioned earlier, less risk than most stock market products.
Yeah.
Unlimited contributions for non-IRA accounts, allowing you to save more. Remember, if you don't have an IRA, unlimited contributions for non-IRA accounts. This is huge because people are always looking for the next place to stash money to grow their assets. This is a huge opportunity here. So you also have penalty-free withdrawals of your interest annually with some of the annuities, and penalty-free withdrawals of up to 10% of your principal with some of the annuities, depending on the contract. So.
Right. Okay. So let's talk about the negatives. One of the things in all of these were the surrender charges. So let's start there.
Yeah, surrender charges. That's the big one that always pops right up. You know, there are penalties that come into play when you surrender an annuity contract before the end of the term. So if you've got a 5-year annuity and you want to surrender in year 4, you're going to pay a surrender charge and you lose some of that interest that you've earned. So they're usually based on a percentage basis and decrease each year of the contract. So if you have like a 10-year contract, which is the maximum allotted in some states, Michelle, it goes 10% first year, 9%, 8%, 7%, and all the way down to 0 when the policy is fully matured. So,
okay. All right. What other negatives are there?
Okay. This is the one that a lot of people do not understand, and they're called MVAs, or market value adjustments. Okay. And according to annuity.org, it's a monetary adjustment that can be applied to an annuity contract if the annuitant, you, makes withdrawals beyond the allowed limits during the surrender period.
Okay.
To me, though, MBAs can be both a positive or a negative inside an annuity contract. They have an inverse relationship to interest rates. When you surrender an annuity during a rising interest rate environment, like right now, the MBA could increase your surrender charges.
Got it.
Okay. But during a declining interest rate environment, the MBA could lessen the surrender charges. And in some cases, Michelle, actually make you a profit.
Right.
So you won't see that right now, but you did see that in the last 3 to 5 years for older annuities that were written at a higher interest rate environment. So, and think about this. Advisors that truly put their consumers first look for this loophole to assist their clients in growing their wealth. Insurance companies don't like that when you let the consumer win. So,
okay. All right. So when you were mentioning the advantages, you were talking about some with penalty-free withdrawals on some contracts. Let's talk a little bit more about fixed annuity withdrawal options.
Okay. So think about this. Some of your, once your fixed annuity reaches the end of the term, Michelle, you have several options to withdraw your money. Again, it's all specific based on your contract, but here's some of the normal standard ones. You can withdraw the principal and all your interest in a lump sum and walk away, right? You may be allowed to renew your contract at the then current rates. Always look at that. So, or you might say, you know what? It's been tax deferred. I might want to roll or exchange my fixed annuity for another one without paying the taxes. And if that's done properly with either a direct transfer, if you have IRA money, or with a 1035 exchange, if you have non-qualified money, not IRA money. So,
okay. Got it.
And make sure you read the fine print of the contract and ask before signing on the bottom line, because some insurers have different withdrawal options. So always know what your withdrawal options are before you sign on the bottom line. So
devil's in the details. All right. Well, let's talk about death benefits.
Morbid.
Right, morbid. Let's get morbid here. It's important because it's so important with these contracts, right? You have to know what you're getting into and also what's going to happen if you pass. So what are fixed annuity death benefit options? What does that look like?
Yeah. This is a question I get asked all the time. What, by God, if something happens to me, Michelle, what happens to my money? Does the insurance company keep that money? And again, it goes back to the devil in the details. Read that annuity contract in there. Look for the specific contract language regarding your death benefit options. So let's say you're the spouse of the deceased. You may have your own specific death benefit options, including the right to continue the contract in your own name to the full term. If you have a current advisor and this happens, make sure you have them run the scenario to see if this option makes sense versus transferring the assets into your own name with a new annuity. Okay. It may, and if you have that advisor for a while, it may be in your benefit to receive a second opinion in this case. Okay.
That's something, you don't hear much about, but when you are sick and there's something really wrong with you, get a second and a third opinion from a doctor. Why not get a second opinion or a third opinion from, a financial advisor, a fiduciary? Why not? It's your money. It's your life.
Good.
It's someone else's money in the case of your death. So
that's so true.
Right.
So, and, there's also a fixed annuity death benefit options. They can be defined in two different categories, Michelle, either lump sum or income. Okay. And let's explain each one in a little more detail. With the lump sum death benefit, when the insured passes away, when you pass away, your beneficiaries receive the full account value in one lump sum.
Okay.
Make sure your contract states that. Some insurers, though, will allow you to take a 5-year payout of the lump sum. That way you lessen any tax burden.
Okay.
So, a lot of details in that. So be very careful in that. Also, a second way is to annuitize or take it out as an income stream. Some insurers will allow you to create an income stream from their death benefit and have it dispersed over your lifetime. But caution here, with the new inherited IRA rules, qualified accounts must be liquidated 10 years maximum time frame.
Yeah, that's big.
It is. It is.
Okay. All right. And I think it's important, if you're watching this right now and you have, whether it's a fixed annuity, you're thinking about getting a fixed annuity, you have an annuity, or you already have a fixed annuity. It's just, if you don't know what the terms are, pick up the phone and make a call and find out how, the death benefits. I think it's important to understand, because the last thing you want to do is something, God forbid, happen, and then your beneficiary has to scramble to try to figure out what's going on, etc.
Exactly.
This is not fair.
No.
All right. Let's talk about the risks. What are there any risks with fixed annuities?
Oh yeah. Just like with any other asset, there's always a risk. And since fixed annuities are backed by the issuing company, the insurer, okay, your main risk is with the claims paying ability of this company. Sure. Can they make good on all their claims? This is why you need to do the research of the ratings of each of these companies prior to the purchase. And below this video, Michelle, we'll drop a few links of places where you can do your research from, like AM Best, Fitch, Moody's, Standards & Poor's. Each one of them companies rate these insurance companies. You need to look at them ratings to see if these ratings are acceptable to you before you purchase that fixed annuity.
Okay. So are they safe?
Yes. I say they're safe. Again, go back to the insurer. If you feel the insurer is safe, the fixed annuity is going to be safe. Okay. So when you open your fixed annuity contract with an insurer, Michelle, you're going to be guaranteed your principal first, and then the rate is your offer to sign up. So whatever that interest rate may be. And insurers must belong to what's called a state guarantee association. And if they default, the guarantee associations must pay up to your state limits. Most of them states, an average is about $250,000 per person per account. So,
okay. All right.
Yep. We'll put a link to that down below also.
To the state statutory limits.
Yeah.
Absolutely.
That way you understand what your state limits are. So,
okay, here's a big one. One of our more popular videos happens to be annuities and how they're taxed, how annuities are taxed. So let's discuss specific, and we'll put the link to that one for sure in the description below. How are fixed annuities taxed?
Yeah, Michelle, they're taxed, and we'll say that is one of the most popular videos when it comes to taxation of annuities. So
who knew? Exciting. Who knew? We shot it and we were like, wait, what?
It's like all of a sudden thousands of views. It's like, but anyways, fixed annuities, Michelle, are taxed based on the funds used to purchase, whether they're qualified like an IRA or non-qualified. So you got to know the difference here. So let's talk about qualified funds. If you use qualified funds like an IRA or a 401k rollover, you're going to be taxed when you withdraw the funds. It'll be considered normal income, and you're going to be taxed on both the principal and the interest.
And the interest.
So if you have 100,000, you pull 50,000 out, you're going to be taxed on the 50,000. Okay. So now let's hit non-qualified. If you use non-qualified funds like cash from your bank account, you're going to be taxed only on the interest earned. So again, let's take the same scenario. You have $100,000 and you grow it to 120,000. You pull out let's say you cash it all out for 120,000. you're only going to be taxed on the
Interest.
$20,000 of interest that you actually earned. So,
Okay. Good to know. All right. Last question. What are fixed annuity rates?
Varying right now and rising rapidly, I may say. You can research on the web for multiple sites that update fixed annuity rates. Sometimes these rates are updated daily, especially in the fast moving market that we have right now. So make sure you're comparing all the different rates, as this, honestly, Michelle, can help you build your wealth over the long haul.
Awesome. All right. That was a lot, but we covered pretty much everything there's to know about fixed annuities in a general sense. Again, as Brian and I both said, read the contract, read the contract, read the contract, because each contract can vary. Well, they do vary.
Yeah.
All right. Brian, is there anything else you want to add?
No, if you got questions about a contract specific that you're looking at, drop them down below in this video, and let's see if Michelle and I can help you answer some of your questions before you make that big leap.
Absolutely. All right. If you like the content of this video, hit that like button and make sure to subscribe so you do not miss another video from us. And don't forget to check out those links below. Thanks, Brian, and thanks, everybody. Until next time.
Thanks, everyone. Thanks, Michelle. Have a great day.